Good afternoon. If you have a phone that is here and it's actually not in the flight mode, could you kindly quickly adjust it so that it's on the flight mode, because this is actually disturbing the recordings that are going on. Please, do we have anyone else to inform me? Just please.
Thank you, Mr. Chiso. Professor Mtuni, my secretary to Treasury, Dr. Matanga, fellow board members. I think there are some bankers, BAZ, who are inside. Yeah, thank you. Mr. Osere, BAZ President, and your colleague, Mr. Biam. I see also my brother, Professor Kumaba, and there's a lot of Atunga. I want to thank all the public for all the contributions and comments that we received during the preparation of this mandatory statement. Your views and the expectations are fair and reasonable. They are fair and reasonable because all what you are saying is the same thing. They are all grounded on one common thread, which is that we want a better financial service in Zimbabwe. So you've spoken, you've listened, and that the mandatory statement, which is on one of the instruments towards those expectations. That's why we represent today. So I'll go straight into the mandatory statement. Give a welcome to you, and give thanks to Zimbabwe for their contributions. This morning, Minister, I listened to, I think there's something called the Class 263. I heard about the expectations and views and comments about what they are expecting in today's mandatory statements. And I read the newspapers. I've also understood the expectations. I think that 95% of those expectations will be made from this mandatory statement. But that is only on the one side of the other side. So the mandatory statement is issued in terms of Section 46 of the Central Bank Act, which requires the governor of the central bank to produce a statement of monetary policy, giving account of monetary policy measures pursued in the preceding 6 months, and the new measure achieves the bank's mandate of maintaining price and financial stability, which is the backbone of economic development. The statement comes at a time when the economy is expanding on account of high consumer demand, increased business confidence within the national economy, and the positive expectations following the peaceful completion of the electoral process and the subsequent formation of a new lean cabinet led by His Excellency President Iji Mnangagwa. The country showed strong resilience to adverse inflationary pressures and displayed tendencies which characterized the run-up to harmonize the nation's period. Moreover, the economy has also been resilient in the negative effects of escalating in foreign currency premiums, which have been a key driver of inflationary pressures. Development during the first half of 2018 were encouraging. We are optimistic that the economy will surpass the initial growth projection of 4.5% this year and register a growth of 5% or thereabout. The optimism is underpinned by better than anticipated performance across the key sectors of the economy, in particular agriculture, mining, tourism, and manufacturing. In agriculture, tobacco outperformed initial projections to record output of 250 million kgs, which is the highest output ever produced in Zimbabwe. This compensated for the expected lower maize output due to poor rainfall patterns at the beginning of the seventh season. In the first half of 2018, there were also significant growth realized in respect of gold, platinum, chrome, coal, among other minerals. The good performance in agriculture and mining is expected to result in spillover effects in other sectors of the economy, such as manufacturing, distribution, and services, thus cumulatively compounding and resulting in a better year 2018. The bank has continued to work on efforts to improve the foreign currency situation currently bedeviling the economy, while at the same time keeping in check the adverse inflationary expectations emanating from parallel market activities and multiple pricing mechanisms, which are a result of deep-seated disparities within the economy. The Reserve Bank has been working on supply-side measures to address some of these disparities through the provision of nostril stabilization facilities, which saw some improvement in the foreign currency situation in the country. Demand measures attributable to fiscal imbalances have, however, continued to increase the supply of money within the economy, thereby eroding the gains and putting too much pressure on the price and foreign currency market as evidenced by thriving power market rates. Despite these pressures, the bank expects inflation to remain within the standard held inflation benchmark, not exceeding 7% by the year end. The bank is also encouraged by the quantum leap in the usage of plastic money, electronic and mobile money payment systems by the Sovereign public. Specifically, the bank's plastic money policy trust has been a resounding success, as shown by the unprecedented increase in the level, volume, value, devices, access points, which has been usage levels have gone up 95% of the retail transactions in this country. The positive expectations under the new administration provide an antidote for anchoring the adverse inflationary expectations and negative investor perceptions, which have characterized the economy in the past years, undermining the economy's growth potential. Indeed, the economy is witnessing a paradigm shift, both on the economic and political fronts, which is critical in breathing a new breath of impetus into the economy. The package of reforms that has been put in place by government since November 2017 provides a strong springboard upon which the economy is showing great signs of sustained recovery. How will it show the foreign currency? Accordingly, this mandate policy statement seeks to cement these reforms by putting in place measures to strengthen the multi-currency system in order to safeguard financial stability, which is important to for sustainable economic recovery, as enshrined in the Vision 2030 of becoming middle-income country with a per capita income of $3,500, which equates to a gross domestic product (GDP) of around $65 billion. Strengthening the multi-currency system is also critical as the economic prerequisite to contemplate the currency reforms and not in place. It is against this background that the bank shall continue supply side efforts aimed primarily at increasing the productive capacity of the economy and the foreign currency generation, while continuing to advocate for the reduction of fiscal imbalances as a panacea for right-sizing or balancing or rebalancing the economy. Measures in this mandate policy statement will therefore need to be supported by a package of measures to reduce fiscal imbalances that are exerting pressure on money supply and hence inflation as a result of increased consumer demand, which in turn requires increased foreign currency inflows. The country needs to live within its means. I'll go over the policy measures. We have a number of policy measures. The first policy measure is strengthening the multi-currency system by introducing separate FCA accounts for Nostro and RTGS funds. In February 2018, the bank introduced a policy that requires banks to ring-fence foreign currency for foreign earners that include international organizations, diaspora remittances, free funds, export returning process, and loan process. Numerous inquiries have been received by the bank, which point to the fact that this policy has not been implemented by some banks on a transparent basis that promotes confidence in the economy. With immediate effect, therefore, all banks are able to effectively operationalize the ring-fencing policy on Nostro foreign currency accounts by separating foreign currency account, FCA accounts, into two categories, namely Nostro FCA accounts and RTGS FCA accounts. Accordingly, all banks are directed to use the Know Your Client KYC principles to comply with the directive to separate the accounts without requiring their clients to complete any other documentation other than for new account holders. Banks have been provided with a period of up to 15 October 2018 to fully comply with this policy measure. Banks are also expected to provide reasonable deposit rates on the Nostro FC accounts in line with international best practice. This policy measure is expected to encourage exports, diaspora remittances, banking of foreign currency to the Nostro FC accounts, and to eliminate the commingling or dilution effect of RTGS balances on Nostro foreign currency accounts. The relationship between the two categories of FC accounts shall continue to be a parity. This is essential in order to preserve value for money for the banking public and investors during the transition to a more market foreign currency allocation system that shall be implemented once the economic fundamentals are appropriate to do so. As a result, as a further support to this measure and to provide credit enhancement or deposit protection for the Nostro FC accounts, the Reserve Bank is finalizing discussions with the African Export-Import Bank, African Bank, towards a $500 million Nostro stabilization guarantee facility to provide Nostro FC account holders with assurances that foreign currency shall be available when required by the account holders. The stabilization facility guarantee will be similar to the AFTRADES. That guarantees that the trade in Zimbabwe, and this is targeted to be in place by the end of October 2018. For the avoidance of doubt, foreign currency in Nostro FC accounts shall be free funds, diaspora remittances, international organizations remittances, portfolio investment inflows, loan proceeds, and export retention proceeds. It is also essential to note that all exporters in Zimbabwe are allowed by law to retain 100% of their export proceeds, with the exception of 6 products. Gold producers at 30%, they retain 30%. Platinum, diamonds, and chrome, they retain 35%, and 20% for tobacco and the gold producers. The rest, they give their own money, their FC accounts. And these FC accounts will be designated Nostro FC accounts. Second policy measure which we have put in place is to put in place credit lines of credit for strategic requirements. The bank has finalized putting in place facilities in an amount of $400 million to cater for importation of strategic requirements that include fuel, electricity, oil, wheat, packaging, and others. The facilities are from GEMCO, $250 million, African Bank, $150 million, and Afro-Grain, $100 million. This $500 million, the facilities are from GEMCO side. These facilities are over and above the $100 million from CDC through Stanchart Zimbabwe, $100 million from EcoBank, $30 million from IDC South Africa through AgriBank, $25 million from ADB through CAPS Building Site. The bank is also negotiating with a number of financial institutions for medium to long-term financial facilities that are needed to continue to bring sanity in the foreign exchange market and to assist in the sustainable recovery of the economy. This is in addition to the external resources mobilization program being vigorously pursued by the mandatory authorities, being Ministry of Finance and the Reserve Bank, to clear the country's external debt arrears to various creditors. Third item, foreign payments transactions. In order to minimize incidence of externalization of foreign currency, the foreign measures which are in line with international best practice have been put in place for banks and the banking public to adhere to. We expect the banks and the banking public to use letters of credit for high-value transactions, or imports to be supported by invoices whose banking details match with the payee's name and the bank account details. Strict adherence to banks by banks to customer due diligence (CDD), and to ensure that export deposits are meted on an timely basis in line with existing rules and regulations. 4. Purchase of fuel in Zimbabwe by foreign truckers in foreign currency. It has come to the attention of the bank that foreign truckers plying Zimbabwean routes are involved in foreign currency arbitrage activities in Zimbabwe by trading in the barrel market of foreign currency and purchasing fuel in Zimbabwe at the official rate of exchange. In order to deal with this rent-seeking behavior with immediate effect, all foreign truckers plying Zimbabwean routes shall pay for their fuel in Zimbabwe in foreign currency. The same shall apply to foreign traders buying goods in Zimbabwe for sale in the neighboring countries, as that is deemed to be an export. 5. Purchase of gold by jewelers in foreign currency. The current policy provides that where a jeweler purchases gold from fidelity printers and refiners using RTGS funds, upon export of the jeweler retains 35% of the export value for own use, and 65% is remitted to the Reserve Bank for national requirements. In order to mitigate against arbitrage opportunities or abuse of this facility, with immediate effect, all purchase of gold by jewelers from fidelity printers and refiners shall be in foreign currency, and that jewelers shall retain 100% of their export deposits so they can do value addition. 6. Settlement of capital gains tax in foreign currency when using offshore funds. In February 2018, the bank introduced a policy that allows individuals with justification to sell their movable properties to buyers using offshore funds, and in some instances to retain the sales proceeds offshore, provided the Reserve Bank approval is obtained. The policy has been well received by the real estate sector, and the bank wishes to enhance the efficacy of this policy by ensuring that all sellers of movable property to buyers with offshore funds are required to pay also their capital gains tax from offshore sources into a Zimura designated FC account. Evidence of payment shall be required during Zimura interviews to enable issuance of tax clearance certificates. 7. Cross-border investment in offshore capital raising activities or initiatives. The Reserve Bank fully supports the presence of local businesses in the region and across the globe for purpose of expanding markets and raising funds to support local operations. In order for the country to derive maximum benefits for offshore investments handled by local entities, going forward, all offshore investments in the form of offshore holding companies intending to dispose of part of their shares to foreign investors shall be required to repatriate all the realized proceeds to Zimbabwe. In case where the offshore holding company intends to expand into other countries, a minimum portion of raised capital equal to the level of dilution should be limited to the country. 8. Introduction of statutory reserve requirement to mop up excess liquidity. Given the increased creation of money within the economy, mainly as a result of fiscal imbalances, the bank shall be introducing the statutory reserve requirement with effect from 1 November 2018 at a level of 5% of RTGS FCA accounts, excluding non-statutory FCA accounts, on a weekly compliance basis in order to mop up excess liquidity from the market. The off-trades window shall remain in place as a lender funds resource facility to cater for financial institutions that require accommodation. 9. Issuance of treasury bills through an auction system. In order to promote transparency in the issuance of TBs, treasury bills, with effect from 1 November 2018, the bank shall be inviting tenders on behalf of government for investors to participate in the auction system of treasury bills. 10. Continuation of savings bond. The bank shall continue to use savings bond for mopping up excess liquidity from the market. As at 31 December 2018, the savings bond had raised $1.5 million. Construction finance facility. The Reserve Bank has expanded the providing sector facilities to include the establishment of a $50 million construction finance facility for retooling and working capital requirements for the construction industry in line with the growing economy. This facility, like all other facilities, shall be disbursed through normal banking channels with an all-inclusive interest rate of 10%. 12. Strengthening the Monetary Policy Committee. The bank is in the process of strengthening the Monetary Policy Committee to provide an effective process of monetary policy in line with best practice and our desired objectives. 13. Capitalization of banking and financial institutions. As the capital deadline approaches, banking institutions are required to revisit their respective capitalization plans to ensure that compliance with the law is done. And the bank requires all financial institutions to submit their plans by the 30th of June 2019. In conclusion, policy measures proffered in this statement are designed to boost confidence, transparency in the foreign currency market, and to rein in inflation by mitigating against rent-seeking behavior, and by government to deal with the adverse effects of fiscal deficit on the economy is critical to contain significant mismatches between the electronic money balances and foreign currency reserves. This is quite urgent and essential because the genesis of money creation and the pressure on the currency is fiscal. Money creation is not caused by mediums of exchange, as most I've heard from most people. That includes mobile banking platforms, Evocash, One Money, Telecel or Telecash, internet banking, RTGS and dollars. These are all mediums of exchange. Mediums of exchange are used to facilitate trade or goods and services, or to withdraw or to access money from either the bank or another banking platform. Mediums of exchange per se do not increase the quantity of money or stock of money in the economy. We need to deal with the root cause where the money is coming from. The bank is encouraged by the positive response by exporters to the export development initiatives that the bank has put in place. The growth in export production and export receipts have been very significant. During the first half of the year, export grew by 36%. The same is true for the financial inclusion initiatives that the bank has been pursuing through timely provision of targeted empowerment facilities in interest groups such as women, SMEs, the youth, and the disabled. These facilities have had significant impact in supporting broad-based and inclusive growth of both local consumption and export generation. As a result of the National Financial Inclusion Strategy, the Women's Microfinance Bank and the Power Bank are now operational. These special banks will help in improving access to formal financial activities by women and the youth who fall under the country's marginalized groups and hence majority of the previously financially excluded population. The bank and the Minister of Finance, through the Ministry, are continuing to give priority to the re-engagement program on the basis of the 2015 Lima value engagement for the clearance of areas which are a great hindrance to accessing long-term finance from the IFIs for sustainable economic development. Detailed debt sustainable models and options are being examined to ensure that in the short to medium term, the areas are settled. Thank you for listening. Thank you for coming. Thank you, Mr. I will now leave this time for the Honorable Minister of Finance, Professor Mtuli, to present some roadmap on the fiscal side. Thank you very much. Please.
Thank you very much. You heard the Governor. Can we hold on to our questions until after the Minister has presented, when we give you a chance to ask questions? It now comes to a part where the Minister of Finance, this is very unusual, the Minister of Finance is going to make a statement now to address and compliment what the Governor said. Honorable Minister of Finance, please. Go ahead.
Thank you very much. He used to be our head of manufacture high school, so we know that longer. With the Governor, Dr. Mabuja, Governor Secretary for Finance and Economic Development was George Ramatanga, Steve Tizo, who's moderating and facilitating, our colleagues, Foreign Ambassador Cumberbatch, and others, the media. Good afternoon and welcome. As the moderator has explained, I felt it necessary from today and going forward that as an accompaniment to the monetary policy statement, I should also say a few words about any major shifts in fiscal policy or indeed just a roadmap, not policy at all, but just merely a roadmap. This is designed to reinforce the fact that fiscal and monetary policy should work together in dealing with our challenges. They are two legs of the same body. Often monetary policy is a blunt instrument for dealing with any economic shocks that need to be dealt with. We cannot just rely on interest rates, curtailing money supply, and so forth, but we need fiscal leg to also play its part. We already heard that although the economy faces challenges and risks, it is still expected to grow to reaching 5% or higher. In fact, we have a range of somewhere between 5 to 6%. And you can imagine if this 6% is realized, we're still not sure. We'll see it in the next few months before they end. If this is realized, then Zimbabwe will join what I call the 6% club, which is those countries in Africa growing at 6% and above. And there are a few of them, the fastest growing countries in the world which are growing above 6% are based in Africa. However, as I say, the quality of this growth is not only does not only face challenges and risks, but also it is not inclusive. Also, it is being driven primarily by agriculture and the mining sectors. Only a few sectors, and even then, we're still losing jobs, not creating enough jobs. At the risk of repeating these challenges, which you all experience every day, that impinge on the impactfulness of this growth, with foreign currency shortages, unsustainable high budget deficit, current account deficit, which we spend time on,
then the emerging inflationary pressures, then the re-engagement process itself is a long slog which we are working on quite hard, the infrastructure deficiencies, and indeed weak social service delivery. But I hasten to say that these challenges are not insurmountable with the determination to make sure that they can be overcome, but they do require some urgent and bold decisions in order to overcome self-economy on a growth trajectory for high growth, sustained growth, and equally shared growth. I must hasten to say one of the biggest challenges is obviously the unsustainably high budget deficit. This challenge is obviously destabilizing the financial sector, the financial sector stability, and of course the rest of the economy. The financing the deficit has mainly been through domestic borrowing, with the use of instruments such as treasury bills, overdraft from the central bank, cash advances from the central bank, arrears and loans from the private sector. Such financing mechanisms are crowding out the private sector, hence constraining production. This also has increased money supply in the economy, translating into exchange rate misalignment and inflation pressures which are already effective, which are building. Similarly, the high budget deficit has ignited the expansion of the domestic debt from a level of something like 275.8 million in 2012 to the current levels of 9.5 billion. This is domestic debt. Foreign debt is currently sitting at $7.4 billion, and together foreign domestic original debt levels of 16.9 billion. So what is the way forward? And here comes my fiscal roadmap. In the context of the above development, macroeconomic and fiscal stabilization becomes critical and urgent and should invariably target the fiscal deficit. A stable macroeconomic environment is an essential precondition for growth and improvement of living standards of our people. It allows individuals, businesses, and government to plan more effectively for the future. In addition, it increases investment and helps to raise productivity. Let me go into the measures and some roadmaps in some direction. Fiscal measures. In his State of the Nation address during the opening of the 7th Parliament, the President emphasized the need to restore fiscal equilibrium. Therefore, in order to complement and support the monetary policy statement that has been announced by the Governor this afternoon, I hereby announce these fiscal measures and give a fiscal roadmap. And all of these pertain to literally the budget deficit and help address the notion of macroeconomic coordination between fiscal and monetary policy. The budget deficit has increased over the years to unsustainable levels, as I was saying. So various measures need to be taken in order to reduce it, so that it ceases to become an albatross on the growth prospects of the economy. Let me start with the financing of the deficit, regarding the use of the overdraft facility that the Reserve Bank has done. The overdraft facility of the central bank stands at $2.3 billion at the end of August 2018, well above the statutory limit of $762.8 million. Consequently, government will effectively limit the use of the RBZ overdraft facility going forward and curtail RBZ advances to government in line with Section 11.1 of the Reserve Bank Act, Chapter 22.15, which states that borrowing from the Reserve Bank shall not exceed 20% of the previous year's government revenues at any given point. Let's move on to the issuance of treasury bills. To date, treasury bill issuances have increased from 2.1 billion in 2016 as a reference point to a cumulative 7.6 billion by end of August 2018. In 2014, treasury bills stood at a GDP ratio of 4.4%, and currently, we can say end of August, we're at 36.5%. You can see a sharp increase over this many years. This is a cost to government, a cost to the economy. Excessive issuance of short-term debt instruments and high interest rates also crowds out the private sector, as I've explained, and compounds increase in government's current expenditure. Accordingly, government, in its management of domestic borrowing, is reviewing the use of treasury bills in support of socio-economic development programs, which are themselves important. Going forward, treasury will seek to finance vital socio-economic development programs by use of instruments that crowd in the private sector, rather crowd out the private sector. And these instruments include public-private partnerships and guarantees to financial institutions. On guarantees, such guarantees will only be a contingent claim on government, unlike treasury bills that have a direct and immediate cash flow implication on government. In addition, recourse to the guarantee scheme will require demonstration by a financial institution that it has made best effort in seeking to recover the loan from a borrower. Precisely, any issues of treasury bills in future will only be through the auction system, as the governor has mentioned, which is a more market-oriented system. This will improve the process of price discovery and yielding and results in better pricing. I've watched the disparity between treasury bill issuances, for example, and the savings bond. And there's, I think, a difference of 3% in interest. That already shows that government is immediately paying an extra 3% because it's not using a competitive auction and market-based pricing system. In addition, the duration profile of the current domestic debt will also be lengthened in line with inflationary expectations. This is important in order to spread out that duration profile so that you do not have too many short-term bills to clear and push them to longer term. But we need a more certain inflation profile for that to be successful for the market to accept. In the area of infrastructure, which is very important, I mentioned earlier the issue of infrastructure deficiencies. The government shall be encouraging the issuance of publicly traded infrastructure bonds, again in order to crowd in the private sector, diaspora participation in national infrastructure programs. This will contribute as well to the deepening of the fixed income market. Move on to the reform of state-owned enterprises. Of course, this item cuts across departments of government. It's not just a Ministry of Finance, an economic development issue, but it's an economic development issue. Government has already carried out an exercise of categorizing all state-owned enterprises according to their degrees of viability, profitability, and balance sheet strength. The documents on this are publicly available. Now, the process of privatization will be accelerated going forward, especially for those enterprises that run highly on the privatization scale. This will not only improve their viability, of course, their profitability, but also strengthen these public-private partnerships in those where government will continue to hold a maybe strategic stake, but also generate revenue, much needed revenue for government from the sales. We'll move on to the external debt arrears resolution. Treasury is accelerating the process of re-engagement with international partners and creditors in order to clear arrears on external debts. Following the roadmap developed in Lima, Peru, Treasury is in dialogue with international financial institutions who are creditors seeking to eventually clear 2.5 billion owed to the African Development Bank, World Bank, and I've included here the European Investment Bank. Simultaneously, Treasury is engaging key Paris Club creditors, bilateral creditors, with a view to restructuring the $2.8 billion debt that we owe to them. Such debt resolution will help restore the international credit standing of Zimbabwe, resulting in improved access to new external credit lines and investment flows. Negotiations of this process will continue at the World Bank IMF annual meetings coming up in Bali, Indonesia, from the 10th to the 14th of October 2018. At this meeting, I will present a roadmap of economic reforms that Zimbabwe will be implementing. And this week, I'll be announcing the full complement of economic reforms that will be implemented over the next 2 years. Let me make a remark on the fuel market, which the governor has referred to as well. The pressure on the Reserve Bank of Zimbabwe to source and allocate foreign currency for fuel consumption on a monthly basis is enormous. I do get phone calls from the governor and other people from time to time on a daily basis regarding this matter. The pressure is enormous. One long-term solution is to create a world-class regional fuel dry port out of our storage facilities in Vuku and in Sasa depot fuel storage facilities. The vision for this inland fuel port will turn it into a vital regional fuel port, serving the neighboring countries who are already buying some fuel from those facilities. This is Botswana, Zambia, and DRC. An additional pipeline could also be added from Beira to the facilities to increase capacity. A strategy in this regard will be developed. Additional investors invited because we need money to realize this vision of a regional fuel dry port. And then the players in the industry can then source their own currency for supplying fuel, sourcing fuel, so they don't have to make phone calls to the government on a daily basis. The concept of a dry fuel port is an important economic development issue. The Minister of Finance and Economic Development worked closely with the Minister of Energy and Power Development in order to realize this vision of a dry fuel port for the region that will turn Zimbabwe into this kind of hub. I now turn back to revenue collection measures. Treasury introduced the intermediated money transfer tax with effect from 1 January 2003 through the Finance Act 15 of 2002. You may recall that. The tax was set at 5 cents per transaction. Initially it was a specific tax. However, due to the increase in the formalization of the economy, the use of electronic money, increased usage of mobile banking, and obviously including the RTGS system-based transaction, there is need to expand the tax collection base and collection points into those platforms of electronic money transfer, including the RTGS system. The information we have so far is that in 2018, up to now, August, 1.7 billion transactions would have gone through as the new board will be announced in due course. In the meantime, Zimra Senior Management will be reporting directly to the Treasury, so there's no gap in governance. I take this opportunity to thank the outgoing board members for the services rendered. The senior management is therefore directed to seize all key recruitments of new personnel within Zimra until a new board is in place. This is to allow the new board to have input into critical appointments. Going forward, systems of Zimra will be upgraded and enhanced in order to improve efficiency in revenue collection, especially at foreign costs. Mechanisms will be put in place to eradicate any corrupt activities that may take place. Almost finally, international financial institutions and partners. I have to say that in pursuing the international re-engagement process and for the purposes of benchmarking our own economic performance as we go along, Treasury will accelerate cooperation with international financial institutions, IMF, World Bank, European Investment Bank, and all the other partners that we have out there, and other international organizations, bilateral partners, some of the organizations which have helped this country in the past. We'll accelerate this. These organizations are a source of capital, of capacity, of advice. So we'll make sure that we stay close to them, because this is the only way to be able to clear our areas and for them to support us as we go forward. Colleagues, in conclusion, I thank you. With this week, monetary policy measures presented by the governor, the fiscal measures that brought back that I've just presented, all aimed at stabilizing our economy. This is the beginning of our reforms in line with the Vision 2030 pronounced by the President, His Excellency, which will seek to usher Zimbabwe into an upper middle income economy by year 2030. As I said earlier this week, we will announce the full bouquet of economic reform and institutional reform measures. This is only the beginning, it's only a part of the package. I thank you very much.
Well, what remains for me is to thank the Honorable Minister for his remarks. Once again, if we can give him a big thumb up. I'm sure that a lot of you who want to ask questions, both the Minister and the Governor are available to take your questions.
And the Secretary.
And the Secretary as well is available to fill his share of questions. What I suggest we do, if you have a question, please if you can say out, tell us your name and the organization that you represent. And I would advise that we limit our questions to 2 per person, so we don't want too many questions, otherwise we lose track of the questions. Okay, so we are open now for questions. You can direct, as we have just heard, direct them to any of the 3 senior government officials in Tanzania. Who would like to go first? Yeah, I recognize the gentleman here. Your name and your organization, please.
Thank you. It's Mark from Reuters. To the Governor, if you could just probably repeat for me the issue. I kind of missed what you're talking about on the auctioning of TVs. Because I think probably this is your 3rd or 4th monetary policy that you've been talking about introducing a public auction for treasury bills.
Okay. Thank you very much. We'll note that question. Governor, I'm sure we'll do not any. Any other question? Yes, sir.
Maybe just listen to clarification on the $2 cents per dollar transaction from 5 cents. Maybe just that clarification. Is it an increase? It's a decrease?
I don't know if it's a word that doesn't. I think I got it. Optimistic view of interpretation of what you say. Well, thank you very much. We got that question. Okay, so we've got 1 question for the Governor, 1 for the Minister. Yes, sir.
Otherwise, I've got to move it. Quick follow-up to the Minister. You made reference to the issue of infrastructure TVs. How much are you intending to raise?
Infrastructure bonds.
Infrastructure bonds, sorry. Over what period of time and how much are you looking to raise?
Okay, thank you very much, sir. 1 more question before we respond. Yes, ma'am. Just switch on your mic.
Happiness, Business Times. So, by reintroducing FCAs, is this an admission that we do not trade 1:1 with the US dollar? And isn't it proper for you to just officially devalue and then with the currency move free float?
Thank you very much. I think we can, Governor, maybe we can ask you to respond.
Thank you very much. Let me tackle a few questions that will relate to myself, and I leave the others to the minister. This is the third time to talk about the auction of toilet bills. You are very right. The Reserve Bank is a government, is a bank that serves two big clients. The Reserve Bank is a bank at government, it's a bank at the banks. So we've got two clients. And the toilet bills, they belong to the government, to the Ministry of Finance. Therefore, our wish is always to do the auction, as you put right. And I'm quite happy that the Minister just presented the same in his measures, his roadmap. And therefore, there's a congruence to what we've been talking about. So maybe it was a delay, on the part of our part as a team. But when you use the term mandate authorities, you refer to both the Ministry of Finance and Development. You take it to our Central Bank, to the Ministry of Finance. So maybe it was a weakness on our part as a team. But now that we've agreed to do it, to start this year, I hope it means that it also add one word that means about our commitment being a client of the bank. Then the second point, I know it was done with the minister about 2 cents or 5 cents. I'll just comment on one part of it, and then I also defer the second part to the minister, whether it's a good or bad. What I can say is that for small purchases, which are small transactions, it is an improvement. Because if bread is $1, 10 cents, and you charge 5 cents, it means that it becomes an aggressive policy. And if you put 2%, it's $12. It means you are not buying, you are not paying 2 cents as opposed to 5 cents for small transactions. But Minister might have the other reasons for doing that, but I thought I should say what is positive side of since myself for small coins. So I love small purchases because if you look at the bulk of the transactions that are going through that system are called small purchases, small transactions. So that's what I was saying, but Minister, this one is yours again. I should know that I should do what I thought was important. Then the last one is on the creation of FC accounts for Nostro FC accounts and RTGS FC accounts. Please, let's be very clear. Let's be very, very clear. The purposes of doing that is to ensure that we preserve money for those who are exporting. We want to ensure that those who are exporting, that money does not commingle with the non-exporting money. Because the goods that lay the golden egg in this economy are exporters, that's what remittances, your foreign currency that's coming to the country. So if you commingle them, what it does is that it brings a discouragement, a demotivation on those who are bringing money. What has happened over time is that when we started this organization, we moved with time, the hunger of money from the RTGS was such money that was low, not to dilute the foreign currency. And over a period of time, I think the minister has been very clear and transparent in giving you the numbers. That is 2.2 billion in the Reserve Bank overdraft, as 8.7 billion of treasury bills. The minister also gave the genesis of the growth from 276, whatever it is, right? Now, it means as we increase more of that electronic dollars, it's reducing the motivation for those with their own foreign currency. And therefore, this measure is supposed to increase confidence. That's why we're also giving a further assurances by providing the guarantee facility for those things. So, yes, you've asked about free float of the currency. I think we've also said it here, very clear, that because we are working on the prerequisites in this economy for a currency reform agenda is suicidal. Let me repeat the term. It's economical suicidal for this economy and for government of Zimbabwe to do what you are saying should do. Why? One way. It means that overnight people offload their RTS balances and they purchase the little formula that is in the market, and therefore it brings in distortion in the market, and by so doing it means that the price will go up overnight, and by so doing inflationary, and you are going to ask for higher salary increases, and at the end of the day it's going to be the spillover effects of that type of thinking, which I'm very much against. This governor, as long as he's alive, will never agree with those people saying that. Thank you.
Minister, thank you for the comments and questions. On the auction of treasury bills and what happened in the past, there is clear evidence that there was not enough coordination between the fiscal side, the monetary side, as treasury bills were issued, basically on a private placement basis, as opposed to putting them out there for an auction through a transparent process to get better pricing and engage in the process of price discovery. We're going to close this gap by making sure that the auction system works. That's the modus operandi going forward. To close that chapter. I would like to see the interest rates of these T-bills come down. As I said earlier, I was watching that the savings bonds are averaging 7%, T-bills rates are issued, they are averaging 10%. So 3% extra cost to the treasury. That's a lot. I could do without that. Sure. Thank you very much. Then all the 2 cents, I think the governor put it well actually. The previous text is regressive. The current proposal is progressive. This is linked to value. So for the small purchases in terms of denomination, it's actually quite progressive, which is therefore lowering the tax liability at that level. It's a fairer tax because in a sense you are paying a percentage of the size of the transaction. So it's much fairer. This includes all the electronic transactions because let's be honest, the ATM is migrated from war where you used to place your card to your mobile phone and other mechanisms. Do you agree with me? That has become clearly ineffective. So it's important to move in that direction in line with the financial innovation that we've seen, and also appreciate, by the way, to see explore in Zimbabwe. I think Zimbabwe has probably one of the highest levels of financial deepening through electronic banking in the world, in fact, in Africa for sure. Now, on the infrastructure bond, there is no size, there's no time, there's no limit, it's just an approach. Because we have one issue when it comes to developing the fixed income market in Zimbabwe. Also, we see it in Africa everywhere. It's not very easy to launch a successful bond unless it's tied to a specific project. But at the same time, government needs to fund these projects, these infrastructure projects, typical for treasury if partners are not willing to do that. So floating bonds, even giving incentives for them to be taken up, is really the way to go. You kill 2 birds with 1 stone, you raise money for a project, but also you deepen the capital market, especially the fixed income market. When things normalize, hoping the not so distant future, you need a fixed income market to have a successful equity market. Because that helps you develop what you call yield curve, some of you know it. Then when you have a proper yield curve, then you can price all other assets of that yield curve. You cannot do that if you don't have a deep fixed income market. And I'm saying that infrastructure bonds are one way to stimulate depth of that market. I think in terms of the FCA accounts, we hope this delineation, separation, price US dollars under matrices, put them in the bank account, suddenly those meeting from outside do likewise, and also support those exporters who are struggling to find their hard-won dollars that they produce in the first place, but can't get them when they need them for imports when they come to the allocation system. So this will go a long way, in my view, strengthening that market.
Thank you very much indeed. Secretary, do you want to add anything? Okay, thank you. I'm very keen that we give everybody a fair chance to ask questions. I'm aware too that the people sitting behind the people standing, I may not be able to see them, but I recognize their hand here. Please, a maximum of 2 persons at a time.
Thank you. My name is Yoko William of Fiscal. My question is to the Minister. May the President please give us more information as to why he has dissolved the senior board?
Okay. Right, another person, please. Yes, sir.
Thank you. My name is Tatira Jumeira. I'm from USA. So I just wanted to get a comment from the governor on the recent parallel market distortions, which have increased inflationary pressures. I wanted to get a comment from him as to what he thinks about that, and if the central bank is working to address that problem. Thank you.
Thank you very much. 2 more questions, please. Yes, sir.
My name is French for probably follow-up to what Tatira has asked. My question is directed to the central bank governor. The question is, Governor, why do we see huge volumes of bond notes and revenue rings in the parallel market when it is not really available in the sector?
My name is Andres. I just wanted to find out from the Minister. I think what caused most Zimbabweans not to deposit their US dollars, foreign currencies they have in possession seem to be a matter of confidence. And they've been told that the US dollar and the bond notes have the same value. And now we're coming back again, we're talking about opening FCs. What do you have as a measure to make sure that Zimbabweans will not fit to bring back their US dollars back to the FCs?
That's for the government, right?
That's for the government.
Thank you very much.
And then second,
yeah, sure.
yes, back to this issue of the increase in taxes from 2 cents to 5 cents.
The other way around.
Oh no, from 5 cents to 2 cents. But yeah, it's involving purchases of higher values that it becomes more. I just want to find out because from my understanding, I think I read IMF article 4 which talks about Zimbabwe being an overtaxed economy. Isn't this worsening the burden of taxes on Zimbabweans?
Okay, thank you very much. We have 5 questions that have been asked.
Thank you very much. The parallel market rates, what's causing them, what are we doing to contain them, or to tame them? I think let's start by the genesis of one of the question. I guess that we are all aware what causes parallelism. But sometimes I am on the pains to understand or to appreciate that some people understand about the cause of parallelism. In Zimbabwe, parallel markets of foreign exchange are caused by the mismatch between foreign currency, US dollars, and the quantity of money in the economy, or the electronic dollars, RTGS balances. When there is that mismatch and the demand for foreign currency is so high, right now, just give you statistics. So, for purpose of illustration, the minister spoke about high demand for fuel. We spend about $80 million per week or per month for fuel. We spend about $20 million per month to procure soya beans and or crude soy oil. we spend about $16 to $20 million to procure our wheat. This year's wheat production is about 120,000 metric tons, which is enough for only 3 months. It means 9 months of the year we are importing. So we have a significant demand for foreign currency. Electricity, we import about 300 megawatts. We pay about $12 million on a monthly basis. When we say that we need to be productive, it means that we also need to be able to feed ourselves. So this year we expect about 30 to 40 or 50, just under 50,000 metric tons. That's a month production, a month consumption. It means that we need, all of us who are here, we consume cooking oil. We are importing 11 months of cooking oil. Now, the demand pressures for foreign currencies are so high. If you go back to the demand proposal that we have given you here many times, is that our import dependent ratio in Zimbabwe is about 45 to 50%. Whatever you consume, it is that 45 to 50% is foreign currency. This water, we are importing the plastic granule. The reasons in South Africa was cooking oil. Apart from the oil itself, which are importing, also the bottle